But I think in 2026, earnings quality is going to be stronger because revenue growth is increasing and the rate of earnings growth is higher. So you have both top line improvement and margin expansion. That should support multiples to actually be higher.
Tom Lee makes an important point. He didn't come into the year with a rigid expectation for immediate gains, but strong early performance is nevertheless encouraging. Why? Because markets tend to telegraph their underlying health early. What stands out most is breadth. This is not a narrow rally dominated by just a handful of mega-cap technology stocks. Instead, leadership is coming from multiple areas of the market simultaneously, a classic sign of a healthy, durable advance. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support. Let's continue.
Market's off to a pretty good start, which was not necessarily unexpected by you?
I didn't have any expectations, but it's always a good sign to be strong out of the gate, as you know, because what markets do in the first week or so give us a hint for how markets are shaping up for the year. Our base case was a rally, maybe to start the year, and then a big correction, and then a rally at the end.
A big correction, if not a bear market.
I think
those are your words, not mine.
Yeah, I think there'll be a point this year where it's going to feel like a bear market.
Yeah. What about the way that the market looks as the year has begun? What do you make of it?
I think it's encouraging because we have some breadth, right? Energy materials are doing well. The Mag 7's catching a bit, and crypto's doing well. But healthcare's strong, financials, industrials are strong, and small caps. I mean, it's sort of a broad market.
I mean, almost want to say an everything rally. It's not like tech is doing terrible. It's just being overshadowed by some of these other moves. The equal weight S&P ETF is coming off a fresh record high of its own. That says everything about what's driven this market.
That's right. I think for investors and for institutional investors, breadth being good is always a good sign, actually.
Is it sustainable? Is this the way it's going to look for a little while?
Well, I do think there's a couple of sort of macro tailwinds that should help stocks. One is I do think that the economic clarity is better because the tariff disruption is more in the rearview mirror, even though we could get that overturned. But in general, tariffs aren't going up. They could be flatter down. And the second is the Fed is really turning into a tailwind because the Fed is leaning dovish. They're focused on the job market. QT is over. We have a new Fed coming. And so all of these are, in some ways, I think, and they're not fighting inflation anymore, a put for the equity market.
What happens if SCOTUS strikes down the tariffs? Is that a positive or negative for the market?
It's a source of confusion. It's going to depend on how they word their decision because, there may be refunds involved and claims. And of course, we know the White House will seek to re-implement the tariffs. But I think on balance, it means that we put a ceiling on the tariffs, that they aren't going to be higher, but there's a chance they're lower. That's a net positive.
I mean, there could be, I was going to use, you use the word confusion. I was going to use a little chaotic. I mean, it could be in the immediate aftermath of that and trying to figure out if, you have to start giving refunds to people, and then you wonder what the bond market may do. So there are a lot of things to consider as we could get this as early as potentially the end of the week.
That's right. Now, some investment firms have already been buying refund claims. They're offering to buy these claims from companies at 30 cents on the dollar. So in some ways, the economy is pricing in some of these refunds.
So one of the questions leaving 2025 was the valuation of the market. What price should you be willing to pay for what the expected earnings are? 22 times is where we were, which some had claimed to be rich. Barclays had a note out today which said they look reasonable. They say 22 times is not cheap by any stretch. In our view, current levels have not historically impeded returns, provided EPS growth remains positive. We do think that estimates are overly optimistic, yet we still expect the S&P 500 to print double-digit earnings growth this year. Do you have any doubt on the strength that earnings will come in at?
As you know, S&P earnings is a mix of all the 500 companies. But I think in 2026, earnings quality is going to be stronger because revenue growth is increasing and the rate of earnings growth is higher. So you have both top line improvement and margin expansion. That should support multiples to actually be higher.
What do you make of the way that banks have gotten out of the gate? They have you look at Goldman Sachs, for example. It's astounding. We're 3.5 trading days in. This thing's put in like 9% already. What do you make of that?
Well, as you know, one of our themes is that we think financials are going to be re-rated more like tech stocks over the next few years because they've proven that they earn money through the cycle. They're big winners of AI, especially the ones that are tech forward. And they have expanding margins and they benefit from lower rates. I mean, in some ways, I think they're pretty undervalued right now.
What about tech? Since you bring it up and so much focus is on it, how do you feel about that right now?
I think the earnings growth is the reason you stick with tech because these are companies with really good market position, good earnings quality, but we just don't necessarily say the multiples should go up. So I think it's sort of like earnings growth with flat multiples means they still can do pretty well.
Pretty well, but would you overweight the group? I mean, if you still think that their earnings growth is going to be outsized relative to everything else, which it's likely to be, right? It almost has to be given what's happening because of AI. Doesn't that speak to the continued outperformance?
100% agree, because let's say the S&P's earning growth is 16. Well, if something's growing 25 or 40%, you'd need a lot of PE compression to underperform the S&P. So I still like tech, but I do think groups like energy and basic materials, which have been really terrible for the last 5 years, can actually outperform tech.
What would you stay away from?
Well, I think that this is a year not to be defensive. And then, of course, as you know, Washington picks winners and losers. Last year, it was bad for consulting firms and bad for healthcare. It sounds like it could be bad for the institutional housing buyers. So I think you've got to be careful about what Washington deems as winners and losers.
In crypto markets, one of the most uncomfortable truths is that price action often repeats itself. Not because history perfectly repeats, but because human behavior does. Fear, apathy, speculation, and complacency all leave footprints on charts. According to Ben Cowen, one of the most important skills an investor can develop is the ability to recognize recurring structural patterns across different markets, timeframes, and even asset classes. In this analysis, Ben Cowen walks through a pattern that has appeared repeatedly, not just in crypto, but across global markets, and explains why its current appearance in stablecoin dominance may signal something most investors are not prepared for.
The pattern is very familiar. We've seen it happen. I've seen it happen on multiple charts, and I've honestly used it to make some pretty good trades on a lot of these different charts. Now, some of them are more indirect, but one of them comes from the Bitcoin dominance chart. Do you see here, and I know you're wondering, how does this relate back to this unfortunate pattern? We'll show you in a minute. Do you see this Bitcoin dominance pattern, how there was like these lows set, and then it would just kind of come back up to these highs. And then once it broke through, it got a pullback and then it just ran for a while. So I want you to remember that pattern, okay? Remember that pattern of setting lows, having some highs, and then breaking through, back testing a little, and then running. Remember that. Now this happened on the Bitcoin dominance chart, and the rest is history. I mean, altcoins just bled to Bitcoin for years after that. Now, there's some other charts where this came up as well in other industries before we get to the one that I want to talk about that relates to crypto, okay? The HSI, the Hang Seng Index over in China, very similar pattern where you have these lows, you have the highs, you break the high right here, you break through, you come back down, form the macro high or low, and then you run. Same thing. We have seen it another time, right? About 4 or 5 months ago, we showed the same pattern with Palladium. You guys remember that, I'm sure. Many of you do. We did a video on Palladium called Dubious Speculation when we noticed all these prior breakout attempts, but it was this one we took notice of, and I made a video when Palladium was around 1,080 or so, about 5 or 6 months ago, saying that we were likely going to have this massive breakout to the upside following the HSI pattern and following the Bitcoin dominance pattern. Now, there's a lot of charts that you'll see this exact same pattern on. But the one that I see right now is very unfortunate. And what I think, and look, I know it's not popular, right? Like, I know that when I express these views, I'm not necessarily making myself any friends. But at the end of the day, all I'm here to do is to present the evidence for where I think the market is going to go. And for a long time, we talked about the fourth quarter of the post-halving year being a potential top for Bitcoin. Now, is it true that the super cycle guys could be right? Yeah, like, it's possible. I'm not saying it's impossible. Maybe you would assign like a 20 to 30% chance of something like that happening. But what I think is difficult for me right now is, obviously we've talked about Bitcoin topping on apathy rather than euphoria, and kind of mimicking the 2019 downturn in a very similar pattern. Like, we've talked about that a lot, and if you actually go look at if you look at the 2019 bear market and you compare it to the current one, you can see we're actually tracking it pretty closely. And as I said before, we topped on apathy rather than euphoria, which is exactly what happened in 2019, which also occurred right around the time that quantitative tightening ended. So those are already reasons why, while I think counter-trend rallies are possible, I think it makes sense to assume there will be sort of a lower low coming by the summer. But there's a new chart that we have to look at, and it follows this palladium pattern. It follows the HSI pattern, the same pattern we've seen many, many times, and it follows the Bitcoin dominance pattern. Every one of those patterns ultimately broke through and continued to trend higher. And the unfortunate chart is stablecoin dominance. That is the unfortunate chart. Because if you go look, and we're just going to approximate here with USDT dominance and USDC dominance, we're not going to add in all the other stablecoins because I don't really think we need to make the point. If you look at stablecoin dominance approximated by USDT dominance and USDC dominance, what you'll notice is a very familiar pattern. A pattern where you have the lows and you have the highs. But guess what just happened? Bitcoin went up earlier, right? But then as it dropped into October, November, December, stablecoin dominance broke through these highs. Now remember what happened when Bitcoin dominance and the HSI and Palladium, remember when they broke through the high on that first move, they then got a pullback, which is exactly where we are right now. We're in the pullback, right? We're in the pullback of stablecoin dominance. The problem is, while all of those charts had the pullback after sweeping above the high, they then ran after that, right? Bitcoin dominance ran after that. Palladium ran after that, and the HSI ran after that. They all went up after breaking through and after the pullback. So the unfortunate argument that I have to make, and guys, the thing is like, if you're an investor, you have to recognize something, is that throughout your investing career, whether you like it or not, right, for crypto, right, and for other assets as well, but crypto is the one I'm making the argument about right now, there will be bear markets, right? Like, there will be. It's not a matter of if there will be a bear market, it's just when is there going to be a bear market. And the reason why it's important to identify bear markets is that so you have some cash to take advantage when the bear market happens. Remember, bull markets make you money, bear markets make you rich. The people that got rich on Bitcoin this cycle were the people that bought in late 2022, not the people that FOMO'd in at like 80K, right? I mean, if they bought at 80K and watched it go up, 20, 30% or something, like, it's not as big of a deal. It was more than, I guess, 20 or 30 from that point because we went to 126, but it's not as big of a deal. If you bought at 15K and Bitcoin goes up to 126, those people, a lot of them got rich. With that strategy. But if you waited, you didn't. And the people that got rich were the people that had the courage to buy when no one else wanted to buy. The end of 2022, just like there were people that bought at the end of 2018 and the end of 2014.
So, whether you lean toward Tom Lee's optimism around earnings strength, market breadth, and supportive macro tailwinds, or you align more with Ben Cowen's data-driven caution around cycles, dominance charts, and downside risk, the message is the same. Markets reward preparation, not emotion. Bull markets create opportunity, but bear markets create positioning. The key is staying flexible, managing risk, and letting data, not hype, guide your decisions.